So once again, welcome to everybody in the webinar today. And this webinar is powered to you by Century Financial. We have started something this month, which we want to continue over the coming next few months, and that is doing a webinar every single day of trading. So this month is going to have 21 trading days, and every day, every night, 7 to 8 p.m., I'm going to be here with you talking about a different topic. So we started with financial literacy for beginners. Next day, it was about behavioral finance, understanding the investor's psychology. Yesterday, it was about fundamental analysis of the stocks and the economic events and their impact on the markets. I see a lot of people who joined uh, today, they joined yesterday as well. And if you remember, I asked you to just buy gold and index and see today at 4:30 that what is the impact of today's economic data. And you must have seen that how gold prices pushed higher, went up almost 15 to $20 up, while the US stock market index rallied $200 before it started coming down. So that's the impact of an economic event. Something as basic as jobs data, it's very important for the central banks to view that data and decide on the basis that what is the next course of interest rates is going to be. Today, we're going to talk about something which is completely different from fundamental analysis. It is called technical analysis. And the field of technical analysis is, as I said, it's absolutely opposite to fundamental, because while um, the example which I gave yesterday, that if you want to go to a restaurant and you need to pick which restaurant you want to go to eat, and in front of you there are three restaurants, and you need to pick one. There is a fundamental way and there's a technical way. The fundamental way is that you go to each restaurant and try their ingredients and see that which restaurant uses what kind of ingredients, how do they cook food, what does the food taste like, and then decide on that basis whether you want to eat or not. And there was another way of choosing the restaurant, and that was the technical analysis way, which means just look around and see which restaurant is more crowded and just go there and eat. So basically, technical analysis uh, is a different area of study as compared to fundamentals. There are traders, investors who follow technicals. There are traders, investors who follow fundamentals. The basic difference between a fundamentalist and a technical analyst is going to be on the basis of the duration of the trade. A lot of people, if you need to buy a stock and hold on to it for a year or 2 years or 5 years, then you definitely need to focus more on fundamental analysis rather than technical, because fundamental analysis will allow you to get into the books of that company and understand fundamentally the business and the core business of the company, and that would help you understand that whether this business, whether this revenue model is sustainable or not, or will it going to sustain the business or not, and on those bases you're going to decide. So it's going to be a very interesting session, guys, today. I have my notepad ready. I hope that your notepad is ready as well. So if you find something really important, you want to note it down, you can. You may also receive the copy of the presentation later on, and the recording of this session is going to be uploaded very soon on YouTube, so you can always have a look at it and find out if you have any other doubts. Normally, as a habit, what we do is, um, because there is no visual connection between you and me at this point of time, so I want you guys to use your chat options and try it out. If you can hear me properly, if you can see my presentation, just write yes or okay, and I would proceed with my presentation. Meanwhile, you can try your chat options, just see if they work fine. Uh, I have already enabled the chats, so I think by now everybody should be able to send um, chats and messages. So if you have any questions, also guys, use your Q&A or chats to write it down, and anything which you want to talk about, please do share. I think it's a very safe space to ask questions, and at the same time, it's a very safe space to share more and more information. So let's try to build this community every day. Um, every time when I start the session, I always feel that we need to be careful of the fact that whatever we are going to discuss over here, it's going to be one of those things where I'm sure you would want to implement this in your live account. But please do ask the risk experts and the investment consultants before you implement anything in your live accounts. It's really important to manage your risk. It's really important to assess your risk. And whatever we discuss here is for information purposes only. And we want to make sure that right information reaches to you. But if you want to implement anything in your live account, please ask the consultants first and only then proceed. Now, with that, some of you have started sending already some questions, of which I will take it once we are through this session. And till then, continue to write whatever you feel and whatever questions you have. Starting with technical analysis, if I were to see the definition, what you see over here, it's a forecasting of future price movements, right? Definitely, it's more than that. But then we need to understand that how technical analysis works. Just to give you a brief idea, technical analysis has been used by a lot of traders, a lot of analysts, a lot of investors, right? And it has received a very collective, very broad acceptance from regulators. There's a whole academic community, which is, and particularly with regards to the behavioral finance, the topic which we discussed day before yesterday. There are some certain technical analysis. We are talking about studies and indicators which follow a specific rule, and you interpret their results in a different way. So there are different tools and there are different technicals and studies. Today, the session is for beginners, somebody who has never done a technical analysis. So we are going to go through the basics today. In the coming next week, a few days, we are going to have one more session on advanced technical analysis, which will involve particularly the studies and the oscillators. Today, we are going to go through the common candlestick patterns and understanding that how do we see the charts. I'm also going to take you through to the live platform so you can try yourself, and later on you can take a dummy account for yourself and try it out. So when we talk about technical analysis, it's a form of analysis which mostly uses two very important things. One is the price of a product, and second is the volume data. So this is something, and this data is basically displayed graphically, and this comes in the form of charts. And these charts can be analyzed by using different indicators, and through that you can identify different opportunities also. So to make it simpler for you, technical analysis will allow you to see some sort of battle between the buyers and sellers, and it will help you to predict that which of these sides might win, right? So this is something which we are looking at. We're trying to find out buyers and sellers of a product, and we are trying to predict that whether the buyer is going to win or seller is going to win, and our investment decision is going to be based on that, for which we need the price, we need the volume, right? We need some studies and indicators to find it out. Now, there are assumptions on which technical analysis is based. And this is really important because every theory has some sort of assumptions. It has some sort of few given, which we feel that if we remove those assumptions, then it will be impossible to identify technical analysis at all. And those assumptions are of three kinds. One is history tends to repeat itself, price moves in trends, and market discounts everything. These three things are really important. These are the very key basic assumptions. There are 5 or 6 assumptions, but these three are really important. Why? Because so history is going to repeat itself. What does it basically means? It means that the price action is repetitive. Certain patterns. And guys, please note it down. My whole focus is going to be on simplifying this thing for you. I would not use a terminology unless it is really important that you must know that term, because it is going to help you in future to understand that what it is about. That is why you must understand a concept in its simplicity and at the same time in its complexity. And we'll try to make things easier for you. Now, when I say the history is going to repeat itself, it's one of the important assumptions of technical analysis, which means you as a trader, when you are doing any kind of technical analysis, you have to keep this in mind, that the price action is repetitive. Certain patterns, they always tend to reoccur. So you as a technical analyst, you have to assume that due to the psychology of the investors and the market, the price movements, they kind of repeat, and this repetition in the movement, it can be charted, and patterns that are likely to repeat, it can be identified. And as we move forward, I'm going to throw more light on this, that what kind of patterns I'm talking about. But then you have to assume that the price action is repetitive. History is going to repeat itself. If a pattern of prices had formed earlier and markets moved higher after that, then we assume that if that pattern occurs again, we might expect that the market would move up. That is how the assumptions in the technical analysis work, right? Similarly, the second assumption which we understood, price always move in trends. What does it mean? The price always move in trends or counter trends. Price moves in trends means that a technical analyst always assumes that price, they follow in a trend. Either it is moving upward, or it's moving downward, or it is just moving sideways, right? It's a combination of this. Once you identify a trend, that where it is moving up or down, you can expect the future price movement to follow that trend rather than go against it. So it's a very common saying in technical analysis that the trend is your friend. You don't go against the trend. So first was, history is going to repeat itself, which means price action is repetitive. Certain patterns, they tend to reoccur. Second is, the price moves in trends, which means if either the market would move on an uptrend or a downtrend or a sideways trend. And if you have identified the trend, you should follow the trend and do not go against it, because trend is your friend, right? And third, one of the most important assumptions, which is market discounts everything. This is a very core assumption of technical analysis, that price already reflects all the known factors which are impacting a product. At any point in time, let's say that price of a stock, say Nvidia or Broadcom or Apple or Google, whatever the stock price you see at any point of time, it already reflects its fundamentals. Balance sheet, income statement, cash flows, economic factors, market psychology, everything is included in the price which you see now, which means nothing can surprise you. The balance sheets, the income statements, it cannot surprise you. The price which you see right now, that price has been chosen by the buyers and sellers, and wherever that price is, that price has discounted all the information which exists in the market, right? Again, now I'm sure the popular opinion will question this, that how is it possible? Because obviously whenever a new information comes out, it does impact the price of the stock. So I understand that, but that's where it is an assumption. If you don't assume this, then you as a technical analyst would never be able to move forward, because you have to think that when you are analyzing market in a technical manner, balance sheet, cash flow, income statement, economic factors, pandemic, tsunamis, you do not consider all that. All you need to know is the price and the volume, because you need to see that between buyers and sellers, who is winning, right? This is a very important thing, guys. I know a lot of you probably might be trading, so you're aware about this. A lot of people know about charts, but what they really not understand is that why the technical analysis exists and why we are expected to follow. You need to assume that the price always move in trends. You need to assume that history is expected to repeat itself. Certain patterns would reoccur, and we have to take decisions according to that. Sometimes traders probably try to mix fundamentals and technicals. Sometimes it works, most of the time it may not. Uh, Maybe if the economic data came really bad and markets started falling and it broke a level technically, then your fundamental and technical both arrive to the same conclusion that it's a sell. And same works for the buy. But maybe sometimes it doesn't work. So during that case, you must not force fundamental and technicals to work together, right? Because these two are different analysis, these two are different theories. That's why it's really important for you to understand that there are these key assumptions which happen. So as I said, there are different ways to trade using technical analysis. We are talking through chart patterns, indicators, trends, price action. Chart patterns we are going to talk about today. Indicators and oscillators we are going to talk about in a different session, in the advanced technical session, because I don't want to fill your head with too much information. So today we are going to understand that how candlesticks work, how charts and patterns work, how you can plot support and resistance, how can you plot trend lines, and that is going to help you understand further about technicals as well. So in a chart, mostly what you see, the charts are represented, the price and the volumes, they are represented graphically, and they are represented in the form of candlesticks, right? As you see the diagram of the candlestick at the moment, it is something um, which is very easy to indicate, right? The candlestick chart, it provides you 4 prices per data entry point, and I remember it mostly in a form of uh, OCHL. Every candlestick, when you will see on the chart, even now also when you can see OHLC, this is the most important thing. For attendees who are looking at this for the first time, please understand the colors. Right now, in modern platforms and in modern charts, you see only two colors, two kind of candlestick patterns, green and red. There are traditional charts, they used to show white and black. Obviously, the black has been replaced by red now, the white has been replaced by green. So you do not focus on 4 colors, you only focus on green and red. I think from the chart it is pretty clear that if the representation of the prices is expected to go higher, or if it is shown higher, the candlestick is green. And if the price action is showing a negative closing, the candlestick is red. So in your modern portfolios, in your modern platforms, mostly you will see a candlestick pattern which is green and red. Always remember this, do not get confused between black and white. One candlestick for a data entry point, it tells you the highest of that particular session, the lowest of that particular session. So look at this candlestick, and guys, please ask me any questions if you feel like. Please write it down, chat, use your chat options to ask me questions if you like. If you see on a candlestick, why do we call it a candlestick? For the very little reason it looks like one, right? If you see, there is a candle shaped body, there is a thread on the upper side, there's a thread on the lower side, the white thin line. And if you see on a green candlestick, what does it show? It shows the highest of the point, lowest of that particular time period, which is represented by threads, and then the base of the candle, which shows the closing price, and the base of the candle, which shows the opening price, the lower base, which shows the opening, the lower base, which shows upper base, which shows the closing. This is in case of a green candlestick. But on the case of a red candlestick, you see the high and low is represented in the similar manner, but the open and close is opposite. Now, this is very important. This is going to form the foundation of your understanding of candlesticks. A candle appears green when it opened at a price X, but it closed higher than the price X. It appears green. If a candlestick opened at $50 and by the end of that session it closed at 55, that candlestick will appear green. If it opened at $50 and by the closing of that session the price ended at 40, the candlestick will appear red, as it is graphically represented that whichever price the market opened, if it closed higher, then the candlestick appears green. Whichever price it opened at, if it closed lower than its opening price, then the candlestick is red. I'm also going to show you a visual platform where you can see the charts. I'm going to take you right here. Just I hope everyone can see this. Today is a red day for the markets. Right. I'm going to open a chart, let's say for US 30, Dow Jones, the US stock market index. Let's just understand. I'm just going to zoom in and show you exactly what you just saw. So I told you, right, that every candlestick, it shows you 4 data points. Can anybody write it on the chat? Which are the 4 things which you can see in a candlestick pattern? Can you use your chats and tell me? Which are the 4 things? I told you OHLC. Can anyone tell me which are these 4 things which you can see on a candlestick pattern? Use your chat options, guys. So only so that you can get maximum retention. Which are the 4 things which can be plotted on this candlestick pattern? So this is a visual representation of the price and the duration, right? So on the vertical axis, from top to bottom, you can see the prices. On horizontal axis, you can see the duration, the weeks, days, and months. Each candlestick represents an interval. So if you see on the top left corner, if you see here on the top left corner, it says 1 day right here. Let me just zoom in so that you can see it more clearly. Should be able to see now. Look at 1 day. If I click on drop down and I make it 5 minutes, now each candle over here, each candlestick represents 5 minutes. So every candlestick opens at 5 minutes and closes at 5 minutes, right? So it has, if it opened at a price and then closed lower than that price, the candlestick becomes red. Again, opened at a different price, closed at lower than that, red. Then again, opened at a price, closed lower. So every time it closes lower, it becomes red. But if the opening price, if the closing price is higher than the opening, then the candle becomes green, right? Okay, some of you have started replying on this. 1 second. I think the chat option is getting disabled automatically. I'm sorry. 1 second. Okay, guys, try it now. I think there's some issue where the chat panel gets automatically disabled. Try it out. Just write anything. If you can hear me properly, if you can see my presentation, just try to write anything. It should work now. Perfect. I think it works well. Nice. Okay. As I was showing you in the current chart, every single candlestick which you see, it represents 5 minutes of the price movement. After 5 minutes, a different candle starts for the another 5 minutes, and every 5 minutes there is a opening price, there is a highest in that 5 minutes, there's a lowest of that 5 minutes, and eventually after the 5 minutes are over, that candlestick closes. And if the closing of that candlestick is higher than the opening price, then it becomes green. But if the closing is on the lower side, then it becomes red. So right now what we are looking at of the price movement of US 30, if you see on a 5 minute chart, there is a constant red candle formation, which means in the last 35 to 40 minutes, because each candle represents 5 minutes, on the last 35 to 40 minutes, every 5 minutes we have seen US 30 falling more than the previous, right? That's why the candles are red, because every time it opens at a price, it closes lower than that opening price. So every 5 minutes, this candle changes. This, you can see this on a 5 minute chart because I've selected 5 minutes duration. See very closely on the left corner, if I make it 1 day, now you're looking at every candlestick which represents 1 day. The lowest of the day, highest of the day. So if a candlestick right here, if you see this, look at this candlestick, for example. This is red. Why this is red? Because the opening price of this candle was here. Maybe let's say it opened at a price of 40,800, but now it is closing towards 40,397. So the day is not complete yet, but because the current price is lower than the opening, that's why the red formation. Even before the close, if the prices climb back above the opening price, then it will become green, like this. So can I say that if this was a daily candlestick pattern, day 1, day 2, day 3, day 4, look at last 4. So if these 4 days shows positive, right, that means market closed positive for 4 days in the month of August right here. So this helps a technical analyst to understand the trend of what is happening in the market. It helps them to forecast of how the market is expected to perform in the next few minutes, next few minutes or hours or days or weeks or next few months also. That is the power of technical analysis, right? Again, guys, as I said, I'm open to questions. If you have anything, please feel free to write down and ask. Okay. As I said, now starting with the first technical pattern, which is called resistance and support. To make things very simple for you, resistance and support. When we look at a price movement of a product, whether it is gold, euro, index, currency, crypto, anything, and when we are looking at the chart, now we are trying to identify the price patterns. A lot of times it happens that when we are looking at the chart, there are some data points or some price points where the price touches and then bounces back. And it can be due to any reason. Sometimes it may be psychology. Imagine gold prices, every time it touched 2500, it would not be able to break 2500, comes down, right? Sometimes it breaks 2500 and then it just continues to move forward. Maybe it was some sort of a psychological barrier for a trader. So because it's a round off number, there's no logic to it, but that is where technical analysis comes really handy, because it kind of tries to find out that what is a good entry price. How many times you log into your trading platform, look at the market, and you don't know what to do? You feel that, okay, maybe it's a good buy or maybe it's a good sell. How do you know whether it's a good buy or a sell? Unless you ask someone or you feel that fundamentally markets are positive. But if you were to see technically, there is a way to find out that what should be your entry or exit points. It's very simple. When you look at the chart, you see that which are those points from where prices have come down to touched and bounced back. That is called a line of support. It gives us support. Price touches this, it's not able to break this support, like a trampoline. Touches and bounces back, touches and bounces back, touches. More touches and bounces back means it's a stronger support. It's not able to break this. But once this trampoline gets broken, then the price might continues to go down. So your stop losses should be below that support line. That is called the line of support. Similarly, sometimes when prices are moving higher and higher and higher, there are some peaks where price touches and then comes down, again touches and then comes down, again touches and then comes down. But when that ceiling is broken, the market just moves forward. So this point, this ceiling is called resistance. Now, when you're looking at a chart, you need to identify strong supports and resistances. You also need to understand that supports and resistance can break eventually. And when they break, a new support and resistance forms, right? But if you plan your trades, if you plan your entry and exits around support and resistance zones, it kind of increases the probability of having a successful trade. And that's really important, because the first rule of trading is you don't just open your account, log in, and just buy things randomly because you feel or you have a gut feeling. You need to look at the price pattern. You look at the trend first. You need to find out that my entry point should be the one where price touches and bounces back. I need to look at the support price and then buy at that support price. And that's really important. I'm going to show you live on the screen that what a support resistance looks like. So let's say gold. I'm opening a chart for gold. Gold currently is $2,514. To give you a more closer intraday approach, I'm going to change this duration of a chart where every candle will represent 30 minutes, right? 30 minutes. And this is just in last 2 or 3 days. So what you see is a 30-minute duration from 5th of September. So today is 6th of September. Yesterday. So from yesterday till today, right? Now, if I were to see from yesterday till today, I will see one very important thing. Look at this, right? And then also, look at this, right? Also, look at this. This is the most important thing right now. Also, I think one closer look towards, I think it is, yeah. Now I've drawn these lines, right? But if you see closely, all of these lines represent something. Let's start with line number 4 in the order you see it. So there is first, second, third, fourth from top to bottom. If you see line number 4, this on a very short term chart, right now that price indicates a price of 2492, 2492. This is on a short term chart is the support which is available, which means your buying can be, or your entry point, one of the entry points can be 2492. Why? Because if you see on the left side of this, a lot of times the price has touched that area and then again bounced back. So that's one. If you see from after fourth, if you see line number 3, that is also a support line, because if you see from that particular support zone, not a very strong support, but still an important support line on a short term chart, that it is not able to break. If the candlestick has hit 3 to 4 or 4 to 5 times on that support line, then it is a good support for an entry point. So your entry point are found through using support lines. Your exit points are your resistance lines. So if you see the first line from top to bottom, see the first line. That first line is what? 2519. 2519 is your resistance. Every time the market reaches to, gold prices reaches to that price, the breakdown of that level is very difficult on a short-term chart. It broke once to 2530 and again came down. Why that single thread is hanging like that right here, for example, if you see there, this thread is the highest, which means the market was not able to sustain, the prices were not able to sustain at this level, right? Touched and came down. So this is a resistance zone. This is a zone of resistance. So you book your profits at 2519 or 2520 or take a short selling position. Now if you see the price is hovering here, so if the price is hovering here, you don't have to enter right now. Wait till it either reaches to 2519, so you can short sell it, or let it come down to 2503 first. And if it breaks 2503, buy at 2492. Breaks 2492, then you might wait, because then your stop loss should have got it. Now I've zoomed out to show you the bigger picture. See how strong 2492 as a support is. See how strong 2503 as a support is. Look at these peaks. Let me see if I can. And once these supports are broken, see what happens. What happens to the prices, right? So that is how support and resistance lines are drawn, guys. This is again a short-term chart. I'm showing it to you. Look at these. Look at here. Look here. And then again, when the support line is broken, see how down it goes. And again, it's here. And right now, the price is here. So you wait for it to buy at 2503 and then definitely buy at 2492, but keep a stop loss below that, below, at least below. So in this case, if I see, if this support gets broken, there is one more line which can be drawn, but then again, this has been some sort of bottom. I mean, this depends on your risk appetite as well. But if you see right here, right, this is again very important, because for reversals have happened from this line. So I would not ignore this, which is 2472. So if you buy at 2492, you should definitely keep a stop loss. If your quantities are less, then you must keep a stop loss of at least below 2472. But if your quantities are higher and on a short-term trade, then you must keep a stop loss below 2492. Could be a 2485 or 2486. And that is how you're trying to plot the support and resistance line, right? Still, if you see, if I continue here, right now on a 15 minutes chart, still appears the price is here. Still not buy. Wait till it comes to 2503. Wait till it comes to 2492, or wait till it goes to 2520. So you can short sell at 2520, or you can buy at 2503. Again, guys, what I'm telling you is for information purposes at the moment. live trade, if you want to place, definitely you need to check a lot of factors. You need to be in touch with your risk experts, and you have to understand that not every single time a technical would always work. But this is how we have to understand that how support and resistance can be used for entry and exits. Next, as I said, the market always move in trends, right? We talk about higher. So when we talk about an uptrend, we talk about downtrends, we talk about sideways also. And that's really important because trend, it's like a long-term pattern of price movement, and it goes in a particular direction. If you see that a product or a commodity is not trending, it is said to be in consolidation. We say that it's consolidating. When you're not able to identify that whether it's a short term, sorry, it's a uptrend or a downtrend or a sideways, we say that it is consolidating, right? Consolidating. And then trend analysis, when we say, it is based on the observation that buyers and sellers, they so what is the observation when it comes to trend analysis? Buyers and sellers, they act in herds. Like, it's kind of a herd mentality. The trends kind of, they stay in the place for some time. So we're expecting, if the trend is moving higher, everybody is just joining that herd because they want to go with the trend. They don't want to go against the trend. So if I say that uptrend, which is the first trend which you see on the left, the stock is said to be in an uptrend if the price are reaching higher highs and higher lows. So every new high is on the higher side, every new low is also on the higher side. And you can see from the pattern itself what you see here. Let's see, every peak is on the higher side. In this case, every peak is on the higher side, every peak here is on the lower side, and this is only for the uptrend. Sorry, every bottom is also on the lower side. So new high on higher side, lows on the higher lows. Downtrend is opposite. Every new high, every new low is on the lower side. Sideways, you're looking at a sort of trading range. We can easily plot even a sideways trend on the chart. I'll help you out to understand this as well. But yes, we have to understand that downtrends, uptrends, they also are there. Uptrend mostly indicates that the demand is more than the supply. Downtrend indicates supply is more than the demand, and that is the reason why a product would move up or down, right? It happens a lot of times. Like, see, there are a lot of common chart patterns. Let's understand that maybe, for example, if I want to uh, see a trend line, I'll go back right here. Okay, let me start with something else. So let's say, let's put this chart here, and I'll take S&P 500 maybe. Or let's take Hong Kong index. It will give you more clarity. Again, Hong Kong index. Now, if you see clearly, or let me convert this into a line chart so I can highlight the peaks and the bottom, the highs and the lows. So if you see, click on draw, click on line. Now, if you see, what was the downtrend when lower highs and lower lows? Uptrend, higher highs and higher lows. Look at this. Look at the peaks. Like, every new peak is on the lower side. Every new peak is on the lower side. This is a downtrend. I'll also, in fact, I'll draw a channel for you so you can easily understand this. See this. If you see all these peaks right here, every new peak is on the lower side. So this is a downtrend. Every new low is on the, so lower highs and lower lows. You see this? Look at this trend, right? Downside. On the other hand, the moment this downtrend gets broken, if I were to find out an uptrend over here, either this, or I'll just go back a little to show you an ideal what an uptrend would look like. Look at this. every new low is on the higher side and every high is on the higher side. Higher highs and higher lows. Look at these peaks, right? Uptrend, right? Look at this uptrend and look at this downtrend. Uptrend, downtrend, uptrend, downtrend, right? Again, and then uh, zoom a little bit more. See how continuous it can be. This was a primary, a secondary trend in a moving primary trend. Look at the primary trend right here. Look at the primary trend. Look at this, right? So it market could move in these kind of trends for years, and sometimes these trends get broken, right? Sometimes market moves in a range, and while imagine in this going trend which started in 2023 and continued for the whole year, if you were on the buying side and continue to buy on a longer period, you would just lose because you're against the trend, right? Similarly here. That is why you should never go against the trend. Need to be with the trend. There's a question here. A chart or a pattern formation is a collective data result of price movement. Can price movement, that is support or resistance, be predicted accurately using candlestick only, or this can be broken? See, the price movement, it's an important question, guys, which was asked, if I understand it correctly, that a chart or a pattern formation is a collective data result of price movement. And can price movement be predicted accurately using candlesticks? Now, what you see here on the chart, the price movement is accurate. What it does not contain is the volume. So obviously, if this price included volumes, then there would be a chance of manipulation, because we would not know that whether the volumes which are predicted in this, the volumes which are inbuilt in this price are right or not. But it's just a price movement. So the price movement, as you see, is accurate. It's basically taken from the live feed. So if you're looking at the current price, the support and resistance is when the gold price touches down, and if it is bouncing back, it is actually bouncing back from that particular price. So the support and resistance which you see, that is accurate. The prediction whether a support or resistance is going to be successful or not, that is always a hit and trial, because supports are meant to be broken also, so are resistances. It depends on at what stage we are at, that we are able to take advantage of the support line, right? The majority of the people, so as I said, that it's about the herd mentality. The support I am looking at, every other trader is looking at. So it is expected that from here, the prices must bounce back. Now, if things are normal, there is no major news or nothing, a support price would really help to boost your entry. Because so the point is that there is one thing, that how accurate support and resistance is. Second is what your focus should be on, that your entry and exit should be around your support and resistance, because you know that these may not be 100% accurate. So there's a chance that when you enter and exit during these lines, your trade might go wrong also. But the probability of that trade going wrong, it comes down by a considerable margin, rather than you entering randomly in the market. I think that is something which is important. Support and resistance definitely can be broken. It's never given. If it was that easy, then everybody else would be doing the same. But the chances, the probability of having a successful trade, it increases if your entry and exits are planned in this manner. And that is something which is, I've practiced it myself, so that I would definitely tell you this, that if your support gets broken, your stop loss must get hit. If your price reaches to the resistance, you must book your profits, get out. But the problem is that when support gets broken, We wait for the prices to come down so we can buy more. We don't put a stop loss. Day traders, if they're not putting a stop loss, they're not going to make money. It is as simple as that. If you're a day trader, you have never put a stop loss, you have continued to make money, it's basically just luck. That's it. There's going to be a day when you're not putting a stop loss and markets are definitely going to win over. And that's the worst day for any trader, because then you lose your entire equity and you feel that this market does not have the potential. But the reality is that when you are a technical trader, when you are doing trading every day, you must know that day ends, trend ends, then next day new trend, new day. So by the end of the day, you must uh, be in a position where you know that what's your risk, and all your trades should be covered and protected. A trade unprotected, that's not a good idea. Right? So this is what a trend would look like. Now coming to a few patterns over here. Now there are a lot of technical patterns which form, and it has some deeper meaning also into it, and I'll try to explain it to you without making this complicated. There's a pattern called head and shoulder, right? Head and shoulder, how it works, as you can see, the mid portion where it says the head, it's slightly higher than the left and the right sections, which is your shoulder. I think if I would be able to sit correctly over here, something uh, like this. So this is shoulder, head, and then this is a neckline, right? This is exactly what the pattern looks like. Now this is very interesting. Why? Because you must know how to trade a head and shoulder. And whenever you see the pattern, this is a reversal pattern, by the way. Please remember this, write it down if you want. Head and shoulder chart pattern, this is a reversal pattern. And normally you see this in like mostly in uptrends also and downtrends also. But again, as I said, it's a not only, I mean, head and shoulders, it's known for trend reversals. It is also something which we have observed in a lot of times, that it has considered to be very helpful, because head and shoulders is a complete trend formation, and reversal patterns are really important because it tells you that from here the market is expected to reverse. So when we see, so for example, as I showed you the neckline, the shoulder and the head, right? Now the point is, neckline is drawn by connecting the lowest points of two bottoms. Like when I say bottoms, which means troughs. So if you see this neckline, see how it is connected from that particular neckline. If you see, it has market has moved up. So from the first part and then from the second part, the market has moved higher from here, so from here and then from here. That is how the neckline has been formed, right? So after this, if you see, once this is normally when it is done, so the slope of the line, it can be up also, it can be down, it can be straight, it can be, I mean, but it does produces a more reliable signal. Now the idea of understanding, first thing you need to see that you don't have to be greedy. If the price goes below the neckline, right, then, so how normally you see it, where the formation which you are seeing right now, the head is the second peak, right? So there are three peaks in the chart which I have shown you. First peak is the shoulder, second peak is the head, which is the highest point in the pattern, and then third peak again is the shoulder. So the two shoulders also form peaks, but they do not exceed the height of the head, right? That's the highest peak. Now with this formation, you put an entry order which is below the neckline. You can calculate the target by measuring the highest point of the head to the neckline. So if you see this head right now, look at the head and then look at the neckline. Okay. Now see the distance between head and the neckline, right? If you see, calculate a target. So measure the highest point of the head and bring it to the neckline. This distance is approximately how far the price will move after it breaks the neckline. Okay, this is really important, guys. So if the price goes below the neckline, it makes a move that is at least the size of the distance between head and the neckline. Look at this. Let me show you here. How do I show you? Okay. Now look at this head right here, and then look at the neckline right here. Distance between the head and the neckline. You measure this using a indicator, using a line chart. And once the neckline gets broken, go for a sell. And your target price should be at least, so there are two ways. Normally, people could go for a sell also. But as I said, that most of the time, what will happen if the price comes down, it goes down. This price, once it breaks the neckline, it is expected that it will fall approximately to a distance, and that distance is the same distance from head to the neckline, right? So it's up to you that if you want to go for a buy once it has fallen down to that level, and after that the price will start moving higher. As I said, it's a reversal pattern, right? So with this formation, you put an entry order below the neckline. It should be below the neckline. You could go for a short sell, you could go for a buy once the market has fallen down. But it definitely, there are two kinds of head and shoulders. There one is there which is telling you the uptrend, but then there is another head and shoulders which is telling you the downtrend. The one which you see on the slide is more about the downtrend. If it breaks the neckline, definitely the market is expected to come down, and your target price should be the distance between the head and the neckline. That should be your target. Head and shoulder is also, the way it can be formed, it can also be a uptrend movement also. Depends on how the formation is and where it is at. So guys, as I said, there are different patterns. Head and shoulders, once the neckline, as I said, the just remember the, I don't want to give you a formula, but normally the pattern indicates end of an uptrend if the second shoulder has the lowest volume. Now, sometimes experienced traders, they see the volume also of the shoulder, and most of the times we are not able to get volume. Just look at the pattern, and you can get uh, advantage, or you can get a profit by going short on the security or on short on that particular product. Your price target should be neckline, like whatever neckline you see, and the difference between the head and the neckline. That's your target. I know it sounds a little bit confusing, but when you do it yourself, if you make a pattern yourself, you'll be able to find out how to take advantage of head and shoulder. So a lot of times the moment neckline gets broken, you go for a short, and when the price comes back to the neckline, that's where you have to see that this is where your target is. So the difference between the head and neck, that is your price target, and once the neckline gets broken, you go short, and exactly how the price target should be reached. This is one pattern. Second technical pattern is double top. Looks very clear to you. As you can see, double top, when two top formations happen, and this is something which has been, again, when we talk about double tops, there is double bottom also. Double top is also a sort of reversal pattern, right? It is formed after there is an extended move up. So the tops which you see are the peaks which are formed when the price hits a certain level, and that cannot be broken anymore. After hitting that level, price will bounce off slightly, and then it will return back to that level again. So the price bounces off that level, starts coming down. It's a double top. So you get two tops, right? In this chart, when you see, you have seen two peaks or two tops after it has moved so strongly. But if you see, the second top was not able to break the high of the first top. That is really important, guys. If you see the second top, it's not able to break the highest of the first top. That is how you know that it is a double top. And this is important. Why? Because This is a strong sign that a reversal is going to occur, because it is telling us that buying pressure is just about finished now. Because first top it reached, it came down. Then again it went up from the neckline, went to the second top, and now again it has started coming down, because and second top was not the high of the second top was not able to reach the high of the first, right? So with double top, the ideally entry order should be placed below the neckline, because now we are anticipating a reversal of the uptrend. So uptrend is done. The moment it goes below the neckline, you should start going short. On the other side, there's the inverse of this is double bottom. Obviously, as you can see, this is more of a uptrend, reversal of the downtrend, which is uptrend. That is where it starts. And a double bottom, it's not that difficult to find it out, because when you are looking at, again, before I move to double bottom, please remember double tops, there are trend reversal formation. So you want to look for these after there is a strong uptrend. You will see that drop is approximately the same height again as the double top formation happens. But then if you look at double bottom, again, if you see the trend reversal right here, there are two valleys, two bottoms, right? There's a first bottom, there is a second bottom. Now, if you see in the chart right here, the price is formed between two valleys, right? Because it was not able to go below to a certain level. And if you see the second bottom in this, it was not able, the low point of the second bottom is not able to break the first bottom low, which means now the market is reversing back. So this is a sign that is selling. It's basically telling you that selling pressure is about finished now, and a reversal is about to occur, right? So this is something which happens even during the price formation. And if you look at a chart, it is very common to find these kind of patterns. You just should know that which are the reversal patterns on the upside, on the downside. So what you see right now is a double bottom, and it has a meaning to it. If the second bottom is not, the low of the second bottom is not able to go below the first bottom, which means now is the time that the market might reverse towards the upside. And if you see here in this particular chart, it eventually goes up and goes above the neckline, right? So this is one of the trends. Then there is a rounding bottom. Look at the pattern, you see the rounding bottom creating a reversal into the uptrend. You can see this on a long-term chart of gold if you ever try. Let me quickly show you if I can plot it here. Let me open gold prices right here. See guys, right here, the gold has broken 2503. Now it is coming actively towards 2492. Right now it is 2497. So possibly on your demo accounts, try to buy at a short-term support of 2492. And if it breaks 2492, then the last is 2472 right here. You see how fast it is going towards 2492 right here. So your buying could be here, your buying could be here. Depends on smaller quantities. If you have smaller quantities, then you can hold till here. If your quantities are big, then you must put a stop loss. But your entry point should be here right now. This is your entry point. Okay, now once this happens, I'm going to go a little long term here to show you the rounding bottom. Let me just go zoom out. Look at this. So if you see right here, this is a big rounding bottom right here. Look at this. For years and years, from 2012 till 2020, right? Rounding bottom like this. Rounding bottom completely. Rounding bottom is again one of the very important, one of the patterns, right? Because when you're looking at the rounding bottom, it's also known as a saucer bottom because it looks like a saucer, looks like a bowl. It's a bowl-like appearance. The recovery period may take months or years. So a lot of times it happens if you are looking at a round bottom, you will see years and years of taking this big bowl forming a shape. So you as an investor should be aware of the patience which is needed potentially, for the full recovery. So what happens is in this entire bowl, the first half of the rounding bottom is when the prices are coming down, and then the base of the bowl, which is the bottom, and then you see the recovery. So these are three parts of a rounding bottom. So the first one is the buildup of the first descent towards the low, right? Trading volume would be heaviest during this beginning of the decline. And again, once the investor starts buying again, the stock is recovering, you will see this entire bull formation. So, I mean, again, as I said, guys, this is not something which is always like 100% correct, but then this also represents the trend in a manner where the first low happens, then bottom, the price bottoms out, and again, it bounces back. It's a gradual shift from downward trend to uptrend, and that can be seen in the rounding bottom, right? So that presents the U shape or the rounded shape. And that's really, really important. So when you're looking at, again, if you see the entry and exit, how you do, entry should be at the resistance level where the uptrend breaks the corresponding level of downtrend. Let me take you to the actual chart. I can sense that if I explain it to you too much, you will get more confused. But then let's have a one-on-one session also on this later on, and we can definitely explain you. So if you see here, this was the lowest here, right? So let's say, for example, this low right here, and then this bottoms out, and then the uptrend starts. So ideally, your entry point should be here. This. Let me see if I can make a. I've created a moving average line just to show you a sort of formation of this. So ideally, your entry point, because this bottoms out, sorry. Okay, so if it bottoms out here and then price starts moving higher, so this is where your entry point should be, because now if you see from this downtrend to the base of the bowl, and now it has started increasing. So this is where you should start your entry point and wait. Your price target should be till here once the entire formation happens. But as I said, guys, this is a very long-term thing. Now, if you see what happened here, even in gold, while we were looking at our 15 minutes chart, right? See, it touched 2490 something and then again bounced back. Look at this line. Here, somewhere. Look at this. Again, bounce back to 2500. So if your entry point is closer to this, higher probability of profit, right? But again, when I say higher probability, that means higher probability. It's not guaranteed, it's not assured, but that's the benefit when you put your trades around these points. Right, so these are some pattern, guys. Again, similar formation will be cup and handle. Cup and handle again is a reversal into the uptrend. So the rounding bottom which creates a cup, and then sometimes from that particular uptrend starts coming down and a handle forms, and that handle breaks out towards the uptrend. So as you can see, it's pretty clear from the chart. So a cup and handle formation is also something which you can see over here. Then there are technical patterns in the form of wedges. Wedges, as you can see, there are ascending wedges, descending wedges. It kind of shows you the channel through which, if the price gives a breakout, so there are people who are mostly waiting for the breakout on these channels, which is, or the wedges, the ascending and the descending. If it breaks out on the higher side, you go for a buy. If it breaks out on the lower side, you go for a sell. And you can find it very easily anywhere. The wedges can be drawn very easily. Let me just show you right on the platform itself. I'm going to let's say German index, for example. I'm opening different products, so you can see that it's not only restricted to one product. If I were to create a wedge and see, let's draw a line. So look at this here, right? And here, this is a triangle wedge though, but let's say even further, if I were to find one, yeah, let's say this is one right here, and another one probably right through this. See, look at this. So these are now, the moment it breaks on the higher side, if you see this wedge, and it continues to move higher. So these kind of technical patterns, guys, it works a lot. But that being said, again, there are different patterns. There are some patterns are much stronger than others, and it's always going to be an hit and trial, but your entry exits will become much more probable, and it will become much more stronger if you were to look into these charts and patterns and then plan your trades rather than randomly entering um, just because of behavioral biases, right? Just because everybody is doing it doesn't mean you have to do it. That does not mean the trend. Also, the trend does highlight a herd mentality, but you should always have an understanding that when a trend has begun, you need the confirmation of the direction, but entry and exit points should be as on the basis of support and resistance, right? So if you need to buy and you see that the trend is on the higher side, so you buy when it reaches to that support line, right? If the price is at a resistance but the trend is on the higher side, does not mean that you buy at resistance, because then the price is going to come down and again you will be forced to close your trade. So that is something which is really important, guys. Again, another form of a pattern which is a triangular wedge or a pennant. Flag and pennants, they also, so if the range is broken again on the higher side, you go for a buy. Range is broken on the lower side, you go for a sell. So that was it, guys, today. This was introduction to the technical analysis. I would suggest taking a demo account and drawing some lines to see the support and resistance zones. We are going to have an advanced version of technicals in the coming few days, and that will be more about moving averages and studies and oscillators, RSI, to understand that how we can take advantage of those studies and enter trades accordingly. If you liked our session, please leave a review on Century Financial, Google reviews on Century Financial, and we'll definitely continue these sessions. If you need more understanding on technicals, please book a one-on-one session with me. I'll definitely be able to assist you more. And it's all about practice, guys. More is in front of you, more lines you draw, you become familiar with the idea. Once you do a few trades yourself, you will know that, okay, this trade worked out, this did not. But try to enter and exit during your support, resistances, and channels, and follow the trend, right? Once again, thank you so much. I'll see you this time on Monday on a completely different topic. The next topic we are going to discuss is going to be about options trading. It's going to be a very interesting one. And options is a whole different product. It's a whole different territory. And I'm very excited to present this to you on the coming Monday, 7 to 8 p.m. So do come, attend these sessions. And as I said, in the month of September, it's going to be one of those sessions where every single working day, every single day of trading, we are going to have one session, one webinar on a topic. Today was about technicals. Yesterday was about fundamentals. Before that was about investor psychology and then financial literacy. Monday we are going to talk about options trading, and the day after that we are going to do a live trading session when the New York opens. So I'll leave you with that. I hope that today's session was informative for you. If you have any questions, you can reach me out one-on-one or talk to your RMs, and we'll definitely be able to answer your questions. So thank you so much. You have a good night. My name is Yogesh, and I'll see you on Monday.